Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What I want to talk to you about are some general areas considered financial planning, but not normally discussed with financial planning. A lot of that deals with financing your homes, financing your cars. We get into mortgages, we get into home equity loans, things like that. When you do a mortgage, a primary principal mortgage, when you purchase a home, sometimes when you get that mortgage, they charge points in advance. And then when you are in a home for a while and want to consider, should we stay with our existing original mortgage or is it smarter to refinance? Now we get into the world where are we refinancing on a new mortgage, or are we getting a home equity loan, or are we getting a home equity line of credit? Do we have to pay points? And we get hit with those questions a lot. So let me start there with this financing and trying to be as efficient as you can with your financing models on, we'll talk about cars and we'll talk about homes. Let's start with homes. When you first buy a home, typically you have to come up with a down payment. And if you come up with enough down payment, you qualify for a traditional, conventional first mortgage. Conventional just means the regular 30-year regular payments, fully amortized. And what that means is it's scheduled with each payment over a period of 30 years to have the loan fully paid off at the end of the 30 years. That's what amortization means. So fully amortized means there's no balance left over at the end of the year. In the beginning years of those mortgages, the majority of each monthly payment, if you look on your statements, will be interest, going toward interest. Today's rates of interest have fluctuated from around 3.8% to around 4.25%, let's say, on a mortgage interest rate. Mortgage interest rates just went up slightly because the Federal Reserve raised rates 1/4 percentage point, and that did impact home mortgage rates a little bit, and car loan rates actually. So when we look at a mortgage, at the end of last year, we might have gotten a 3.8% 30-year mortgage if your credit's good, and we might now be paying 4.2% for that same mortgage. But looking back into 2014 and 2015 and even the beginning of 2016, it's been as high as 4.4%. So the rates have really bounced between really around 4.4% down to as low as maybe 3.6%, let's say, bouncing around there. So rates aren't high now, rates aren't low now, relatively speaking, over even the past 5 to 8 years. The reason I bring that up is one of the strategies or reasons we look at refinancing a mortgage is maybe we're paying 6 or 7% and interest rates came down since we first took out our mortgage. The other thing is maybe we didn't have enough down payment. We didn't put as much down because we didn't have as much money. But our home values have now gone up a little bit. So when we first financed the first mortgage, maybe we only put 10% down. Maybe we only put 5% down. And now the same balance on our mortgage that still remains, if we totally refinance that, in comparison to what our home value is worth today, the loan might only attribute or account for 80% of the value, or it might only be 70% of the value. So if you refinance the loan, you might qualify for much better terms because it's a better debt to equity ratio. So there's less debt percentage-wise. Might be only a 70% or 80% loan. Banks like that. So that's a reason some people choose to refinance. When we look at other reasons, remember I said if you had a low down payment, you might have had to purchase PMI, and that is a mortgage insurance. that usually stays on the loan forever. It used to be PMI insurance was an extra fee if you did not have enough down payment to insure the bank making the majority loan, the main home loan, that if you defaulted, PMI insurance would pick up the first 10 or 20% of the equity toward the home, so that the bank was still only on the hook for the equivalence of 80% of the value of the home when you first financed it. So they're insuring that difference because you had too low of a down payment. Well, it used to be once you got that mortgage paid down to where it was now only 80% of the value of the home, they would jettison or cancel that PMI insurance restriction. That would cancel and you would no longer owe that additional payment. So it saved you $100 a month or whatever once you got to 80% loan to value ratio. Lately, the last 5 or 6 years, the PMI insurances, once they're on the package, never come off. You could have that loan paid down to 50% and you're still paying PMI insurance. So there's a reason some of you that have PMI insurance might want to relook at refinancing to see if a new refinance for the exact same amount you owe on your loan might be 80%. You might be able to refinance on a new loan at the same payment or less, at the same interest or less, over the same remaining term or less, and not owe that PMI insurance. So there's a way to save some money if that's the case. That's worth looking into. Now, another question I get on refinancing is, should we just refinance? Maybe we could shorten the term. Maybe we can lower the interest. Maybe we have additional money on this side. Should we add that to our mortgage balance? And if we refinance, we can now refinance less. So that brings the question, should we try to pay off our home loans early? There are a number of issues with that. So I'll start with, yes, you can add additional, there are a number of ways to pay your loan off early. There are a number of ways and reasons to refinance a mortgage. So let's talk about this. Number one, if you refinance a mortgage, the first question to any bank is, are there fees or points you're going to charge if I refinance my mortgage? So let's say we have an $85,000 or let's say we have a $125,000 balance on our mortgage. Let's say we have 25 years left on a 30-year mortgage. Let's say it's a decent interest rate. So we're not really financing necessarily for the interest rate change, but we just wonder if we can shorten this thing up. So, or save some money or both or whatever. So we look at the situation, and the first thing is we go to either mortgage brokers or we go to banks. I will tell you, if you have a financial planner who has knowledge of some reputable mortgage brokers, they are a good alternative to simply going to the bank. So I don't want you to go to one or the other. I want you to go to both. And I want you to inquire from one or two banks the information, if I refinance this mortgage exactly as it is for the whole $125,000, can I get figures from you on what the monthly payment is if I do a 15-year mortgage, even though there's 25 years left on the balance I have, or a 20 or a 30? You're asking them different scenarios. You'll ask them, if I refinance it, I don't want to take a new 30-year mortgage, most of you would say. Do you have a 25-year mortgage? Because that's my remaining term. Most banks and mortgage brokers will say no. It's either 15 or it's 30, and that's traditional. So you'll say, okay, I don't like either one of those, but give me the numbers for the 30-year mortgage. Give me the numbers for the 15-year mortgage. So you'll get those two numbers. And the payments might only be, I don't know, $150 a month difference. So one thing I need you to know is, even if you take a 30-year mortgage, and you also need to ask the interest rate. What's the interest rate on the 30-year mortgage? What's the interest rate on the 15? typically you will find the interest rate on the 15-year mortgage is slightly less, lower number than the 30-year mortgage. So you look at that and you say, all right, I have my numbers now. Here's a secret. I'm not saying it's an answer, but it's a secret worth knowing. Even if you took the 30-year mortgage and wanted it paid off in 20 years, there's magic that you can calculate. If I only add an additional X dollars every month to my 30-year mortgage payment, even the one you have now, without refinancing, would it pay this mortgage off in 15 years instead of 25 or instead of the 30? You'll be surprised at the small incremental difference in the monthly payment. So even with your current bank, the one you have now, your first question might be, I want to start paying this off earlier. Should I add lump sum dollars to it? Let's say I have an extra $30,000 or $20,000. Should I put that onto the mortgage? And they might say yes, but that your questions can't stop there. It has to be, should I pay it off on this mortgage? Should I refinance a new mortgage? Giving you the money, bank, so that I'm only financing $100,000 then, and maybe I can finance $100,000 for 15 years because I added that extra, and I'm done. I don't want a long mortgage. I want to finish this earlier, and I don't want to be dumb about it. I want to be as efficient as I can. So that's one option. But the other option, don't forget, is adding an additional amount monthly onto the payment might get you to the same place, and you don't even have to refinance. So you might have $10,000 sitting aside or $20,000 sitting aside you were looking to pay in advance on your mortgage. Well, if that $20,000 is earning any interest rate at all, or if you can get it to earn any interest rate, maybe you can get it to earn 5%. If it can earn 5%, that's $1,000 a year. You look at that and you say, well, $1,000 a year, that's $80 a month. And maybe the $80 a month interest I'm earning on the $20,000, if I add that $80 a month and I don't give the mortgage the $20,000, does that $80 a month cut this 25-year payment down to 20, and I've got my mortgage paid off in 20 years, and I still have my $20,000 in cash? Versus, hey, bank, what if I give you the $20,000 in cash? Maybe that waves a magic wand and automatically pays it off in 15 years. Because any additional payment above your scheduled mortgage payment typically applies to principal first. And what that does is it knocks off from the back end, the 25th year in this case, it knocks off the back end any principal that's owed and all the accrued interest that would be growing on that principal amount. That's why they pay off so short. So you have great opportunities there. Number one, call the bank, the existing bank, and ask, if I give you extra money, here's $20,000, do I even need to refinance? Or does that automatically shorten my existing loan up to 15 years, let's say, and I just keep making my payments the way they are? Number two, what if I have that and I raise my payments? So it's funny money math. You can mix and match with your budget and say, I can afford this, I can afford that, here's what I'd like to do. Another scenario might be, no, I don't want to pay extra on my mortgage. I want to reduce the payment on my mortgage. And I want to shorten the term. Well, there now, let's get back to basics. 25 years in my example, remaining balance on a mortgage. Even just refinancing a mortgage to 15 years, who knows what your existing interest rate is versus the new lower maybe potential interest rates are. Anytime you refinance though, and a lot of times the mortgage brokers will do a better job for you at finding you favorable mortgages based on your existing credit rating, whether it's good or not, than the bank, so you want to check both. But you relook at this anytime you refinance, you say, are there points? Points mean an upfront fee or an advance of interest is what they truly are. 1% or 2%. You don't want points on a refinance. Then we get into the discussion the banks will throw at you, or everybody will. Oh, we'll do a home equity loan. We'll do a home equity line of credit, which I'll get to next. A home equity loan is generally referred to when somebody refinances. I don't know why they don't call it a first mortgage anymore, because traditionally the way mortgages work, when your home's free and clear, whatever mortgage is first placed on your home after that, or upon initial purchase, is considered a first mortgage. But all the banks and all that call it home equity loan, or home equity line of credit. They are two different things. They kind of work the same, but they're not. The home equity loan is typically on a fixed term, 15 years, 30 years, fully amortized. A home equity line of credit is actually not money yet. It might be a line of credit put on your home that somebody says, I may need extra money at some time. Can I open a line of credit against my free and clear home? And somebody will say, yeah, we'll give you a line of credit up to 80% of the value. And you'll say, okay, fine. So you have a line of credit from which you could draw. They might even give you a checkbook against it. You can draw and take loans out against your house. But they're more like consumer loans collateralized by the house. They are more likely fluctuating interest rates. They're more likely consumer-based interest rates instead of a normal home mortgage interest rate. So you won't normally see 3.5% to 4.5%, 15-year payback terms on those. That's more like a floating line of credit. You can add to it. You could pay it back partially or in full. You could go back against the line and get more money out sometimes. Other times, that's an open-end line of credit or a home equity line of credit. A closed end would mean we'll give you the line of credit now, but once you pay it back, you cannot take it out again. So don't separate these terms: home equity, line of credit, home equity loan. Loans typically fixed just like a mortgage or almost just like a mortgage. Watch your interest rates. Is a home equity line of credit different than a first mortgage? Is a home equity mortgage or loan different interest rates or different fees than a first mortgage? Sometimes they'll say, we want to do a home equity mortgage because there are no points or fees. A primary mortgage would have points and fees. So study this a little bit, but there's the way to go. Some people will just simply add additional money onto their mortgage, like I said, their existing mortgage, which is fine. When we get into this area, you want to be at the banks, you want to be at the mortgage brokers, because they'll help you sort through this whole area. For those of you who truly choose to refinance and even add money to it to reduce the payment and reduce the principal, you will be pleasantly surprised. But I need to caution you on something. We're in historically low interest rate periods right now. But I've been saying this for 15 years. We all expected mortgage rates to have gone, and inflation, to have gone way up by now. I mean, this has been since the late 90s, and we in the financial community have seen artificially low mortgage interest rates, CD interest rates, bank interest rates, even regular loan, everything interest rates, very, very low. We feel artificially low, generated and expanded because of the Federal Reserve's decisions they had to make in 2008 and 2009 to protect the economy, to artificially hold interest rates, the Federal Reserve rates, down to near zero. So bonds pay near zero, CDs pay near zero. That can't last forever, but we sure thought it would be over before now. Well, Donald Trump is now talking about he wants a weaker dollar, and presidents before him have shuddered at the thought of talking about weaker dollars because that might, it's portrayed, lead toward a little bit of inflationary pressure, which would raise interest rates. We've seen the Federal Reserve show signs of easing on this policy of holding and depressing interest rates down and loosening up on that and allowing some Federal Reserve rate increases. So we do expect to see some easing now in the new administration and allowing for interest rates to begin starting to increase. So for this discussion for you mortgage borrowers, yes, now might be the window, although for the past 15 years, we've thought there were a lot of windows. Finance now, refinance now, it won't be here next year, and it has been year after year after year after year, we've been wrong. Maybe we'll be right this time that the pressure pot cooker on interest rates increasing is about to be lifted and the interest rates will start to rise again. And this will be the last time in history of our lifetimes that we'll see these 3.5% and 4.5% rates. For the next 30 years, we may not see them again. So yes, we do want to be prudent here and take advantage of these rates while they're here. And if you have a discussion with yourselves on should you refinance, yes, now is the good time to make good long-term financing decisions on your home. So again, you can refinance, and you need to look at all of these. Refinance without putting additional money onto the mortgage. Refinance and ask what additional payment amounts you can put. They're so small sometimes to shorten your loan to 20 years or 15 years. It's startling. And that means why use up that big pot of money when you can get to the same place on little dribs and drabs that won't affect you. Number 3, you might want to refinance and lower the loan payment. That happens a lot. You've already paid part of the loan down. Your original loan is still based on your old higher principal value. When you refinance today, just based on your existing balance, you might be surprised that reduces your payments and reduces your loan time. Might not be 25 years, might be 20 years. And the loan payment came down a little bit. So who knows? Look into that. And then you want to look at the other magic that I said. You could take out a 30-year mortgage and still have it paid off in 15 years, usually by paying that same difference. So if you find out a 30-year would cost this a month and a 15-year would cost this a month, and if you pay the difference, it probably will get that 30-year paid off in 15 anyway without taking the 15-year loan. And then finally, you have the option of, what if I add the additional money? How much will my payments be then, and what will the length of term be? When you do all that research and you get all that information, you call my office. I'll help you sort through those finality of all the answers. You can tell I know the different nuances here. And I'll help guide you to the best decision you can make at this important point in time when we might finally be at the point of low interest rates that we might not see again for the next 30 years. Who knows? All right, folks, thanks for tuning in to another edition of All Things Financial. We ran out of time because I wanted to get into car loans versus leases, and we just didn't have enough time. So maybe on another show I'll touch that. But thanks again for tuning in. I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.